Action. We are joined by Ross Gerber. He is the president and CEO of Gerber Kawasaki. Thanks so much for joining us, Ross.
Hey, my pleasure. Thanks for having me.
So let's start with this subscriber data that we were just speaking with Dan about. So Netflix saying that it lost 970,000 paid subscribers, fewer than the 2 million that it had expected to lose. What do you make of that?
Well, they've more than said that it's very hard for them to predict subscriber growth. So, I still think losing subscribers is not a great thing, but relative to their expectations, it was a decent quarter, I guess, from that perspective. But I think the guiding to adding subscribers in the next quarter is also a very positive thing for Netflix.
Yeah, so they're estimating that it would that Netflix would add 1 million net new subscribers in the current quarter. I mean, that's pretty significant. So they're going to make up for all the losses of the second quarter.
Right. And I think the power of their content, sort of shines through. And I think that's what we've seen, as well as some really nice cost discipline with the earnings numbers. They beat by a pretty good number on actual earnings. And, because Netflix is trading at such a low valuation, earnings are still going up. And even though they're guiding low, as all companies will, we think that companies are just being super conservative right now.
I'm seeing that revenue came in lower than expected, growing 8.6% to $8 billion. Operating income fell 15%. Netflix said foreign exchange fluctuations weighed on revenue and profitability, and projected that revenue growth would slow to 4.7% in the third quarter. That was terrible in terms of throwing so many numbers at you, Ross, but I wonder what you make of that.
Well, I think what's happened is Netflix has become a mature business, which, was a very fast growing business for most of the time we've owned Netflix. And the fact that it's a mature business isn't per se bad, as they're now, looking at other ways to drive revenue. And I think that's really what makes Netflix interesting as an investment. We still think there's a lot of growth in subscribers globally over time. But I think when you're at 220 plus million subscribers, obviously you're only going to grow so much relative to when you had, let's say, 20 million subscribers. But I think what's most important for Netflix is monetizing the IP that they have and the steps that they're taking to do that, like working on their ad-supported streaming platform.
Excuse me, I'm not in shock here. I just caught my breath for a second there, Ross. But I'm also reading here about a letter to shareholders that Netflix wrote, saying that it would likely start its ad-supported tier in a handful of markets where advertising spending is significant. They say, like most of our new initiatives, our intention is to roll it out, listen and learn, and iterate quickly to improve the offering. So our advertising business in a few years will likely look quite different than it looks on day one, which is sort of interesting. I wonder what you think of that little snippet there from the letter, but also just the intention behind this ad-supported tier.
Well, that's one of the reasons we've increased our investment in Netflix on this decline, is because we think the team led by Reed Hastings and Ted Sandros is just super smart and very capable. But most importantly, they're really smart at listening to the consumer. And I think what they're moving into an area they haven't been before with an ad-supported channel. But I think there's so much opportunity, because we suspect that, up to a third of Netflix viewers don't pay for the service. So by, forcing these people onto an ad tier, Netflix can monetize a lot of users they're not monetizing right now. So we're super bullish on this idea, and we think there's lots of synergies with Microsoft. We're very excited with the approach, because we want them to do something that's really complementary to the business, not something that cannibalizes paid subscribers. So that's why this approach makes sense to me. A little at a time, look at what's working and what's not working before you, do something huge in the United States, which may or may not, succeed. So I like this approach, and I think they're going to be successful, and that's why we're investors in Netflix.
In this letter as well, the company said that it's working on an easy-to-use paid sharing offering that they say that they believe will work for our members and our businesses that we can roll out in 2023. So, like you were talking about, all of those people who are password sharing that are watching Netflix but aren't paying for it. So, I guess one route is to go the ad-supported route, where you can get that for a cheaper price, or pay a little bit more and get one that can be shared, not just within screens within your own household.
Yeah, I'm sorry, millennials. You're going to have to pay one or another. I'm sorry, all of you guys who haven't been paying for this service for a decade. You're going to have to pay one way or another, because they're going to hit up your mom and say, for $2 a month, you can get your kid off your profile and stop having to watch shoot 'em up movies when you really like love stories. And the moms are going to say, I'll pay the extra $5 a month or whatever to get my kid his own login, And so I think by offering two solutions, like the add-on for the kid, or you're going to watch ads, is the right approach. And I think there's a lot of people to monetize. If you really look at Stranger Things finale and you really figured out how many people who watched it actually paid, you would be shocked at how many people haven't paid. And so I think that there's a huge monetizable audience base that they haven't addressed, and they are addressing, and they will be successful.
For the record, I pay for my own Netflix, Ross.
Thank you. When I do this in my firm, it's like they all look at me like I'm not paying, and I'm like, Come on, guys, you guys make money. Like take it, buy your own pass,
I wonder what you make of just Netflix's market share. It's the competition. It has grown so much. How does it sort of hold on to this position that it's had as the leading streaming giant?
Well, the competition is real now, right? I watch all this stuff. I invest in it. So we've been looking at Paramount, because Paramount Plus is solid, and Paramount's had a good run in the theaters, and we've kind of passed. And Peacock doesn't make a lot of sense to me, and but Hulu and Disney Plus really being, I think, the main competitor, and then Apple TV will be a bigger and bigger competitor over time. So Netflix isn't a one-horse pony, but you have to look at all the people still paying for linear TV and cable that will eventually get off those platforms, more likely than not. And then the fact that, once again, it's a global business, so they can grow. Facebook has, let's say, 2 billion users. So in theory, they could grow another 100%, over time. And it's really just how fast that would happen. And it's just harder now because there's so many people already have Netflix. So it's a mature business, and I think the competition is real, and that means that management has to step up their game on a content level, on an execution level. And what we think is Netflix needs to build communities through live events, which they're doing, and through having things in theaters where fans can get together. And I think Netflix understands this too, because building the communities around the IP is really the secret that Disney mastered around Marvel and Star Wars. And that's what Netflix needs to do. So, the more they get like Disney, the better.
Ross, just in case people missed it off the top, just if we can come back to the subscriber growth, because I know that was, the big focus going into this. So the expectation that Netflix had laid for this was that they were going to lose 2 million paid subscribers in the second quarter, but they only lost 970,000 paid subscribers. What sort of, what sort of sign does that send that, it's half as much as the company was expecting? Is this, a good sign, or is this 1 million paid subscribers lost?
It's not a good sign. I mean, losing subscribers is not a sign of, wow, this is great. No, I think Netflix is going to have to fight for subscribers, and they have to deal with churn. And they're working on many strategies to do that, because what a lot of millennials do is they'll cancel the subscription when there's nothing on, and then sign up for something else while they're watching that, and then cancel that, and then move back when there's something on. So that's why Netflix has been trying, pacing out Stranger Things, which they've never done before, where they released most of the shows up front and then kept a couple shows back. And I think that's the testing they're doing to keep subscriber churn down, and hopefully, keep subscribers from doing this, but I think, as I said, I think them getting back to growth of subscribers is crucially important. They had a huge huge uptake during the pandemic. So people have to keep that into account and smooth out a graph from, let's say, 2015 to 2022, and you look at sub growth, there's going to be this dip in here that's not surprising, considering most of us are going to the beach and spending a lot more time outside than 2 years ago. And so, I think they'll get back to growth, and I think they've got great strategies to employ. And I think this is a tough transition period for Netflix, and I think the valuation more than shows that. And that's why there's opportunity in Netflix. If they do anything right out of all these things, the upside is substantial.
I wonder, Ross, in this sort of economic environment that we're in with, inflation at the heights that it's at and, the concern about recessionary worries, I mean, is it perhaps optimistic of Netflix to be expecting to gain back all of those subscribers? Could there be an impact, where people are pulling back, that extra spending on things like subscription services?
Well, traditionally, entertainment was always considered recession proof in that, it's an escape from hard times and watching shows, so that was sort of the old school mentality to these types of, I've been a Disney shareholder my whole life, and that was sort of the idea, so I just don't think that's the easiest thing to cut spending wise when you're trying to cut spending, like cutting Netflix is a way to get all your kids pissed off, So you got to ask yourself, do I want to get rid of the things that keep my kids busy? Because that, Sea Beast movie was pretty entertaining, And so maybe I just am going to drink less. And clearly that's not happening because beer sales were up 20%. So when you look at, beer sales across the board or what's happening in restaurants or look at travel, like if people are worried about money, there's a lot of places they can cut back before cutting Netflix or Disney or, those kind of things,
Ross, the pop in the shares that we're seeing in after hours trading, I just wonder, were expectations so low? And this kind of goes not just necessarily for Netflix, but for other companies that we'll be watching out for as well as they report earnings. Have expectations been lowered to a place where we might see, outsized reaction to the upside when you see, a more positive number like this subscriber growth? Because at the same time, like we talked about, revenue coming in lower than expected. So, there is
yes, but
still
earnings per share was up substantially higher than expected.
Right. Okay. I mean, so there's a lot to watch for
earnings
there.
Per share is what matters. When you're looking at PE ratios, I need an E. You know what I mean?
Yeah.
So, that's part of the pop because, look at the valuation of Netflix trading at, let's say, 17 times earnings, right? And so if E is bigger than expected, if the stock has to go up, and that's where I think a lot of stocks are in the stock market, where they've gone down so much, there's so much negative. I haven't seen this much negative in a non-recessionary environment like ever. And so, as earnings come out, I think what's happening is if they're not horrendous, maybe the worst case scenarios aren't going to play out. And investors have tons of cash right now, and they're looking at a 3% bond, or they're looking at high yields at 6 and 7%, which is attractive compared to the past. But they're saying maybe if I buy Netflix at 17 or 18 times earnings, and they really can get earnings going again, I'm going to make more like a 20% rate of return over time. And I think investors are looking at valuations in companies like Netflix and saying this is compelling because the worst case scenario isn't playing out.